Vermilion Lloydminster Wainwright, and Chair of the committee.
Is now joining.
I'd ask that members and those joining the committee at the table introduce themselves for the record, and then I will call on those joining by video conference. We'll begin to my right.
Danny L., Fort McMurray, Wood Buffalo.
Grant Hunter, MLA for Tabor Warner. Good to be here, Mr. Chair.
Sandra Lau, Interim CIO, IMCO.
Gosh, Chief Fiduciary Management Officer.
Evan Siddall, Chief Executive Officer, IMCO.
Lowell App, Assistant Deputy Minister, Treasury and Risk Management.
Eric Petty, Director Financing, Treasury Risk Management.
Nelson Roby from with the Offices of the Auditor General.
Brad Ireland, Assistant Auditor General.
Sarah Hoffman, Edmonton Gladora.
Good morning, Christina Gray, Edmonton Millwoods.
Good morning, Jasbir Diol, Edmonton Meadows.
Good morning, Rhonda Sorensen, Manager of Corporate Communications.
Good morning, Nancy Robert, Clerk of Journals and Committees.
Good morning, Warren Huffman, Committee Clerk.
Okay, thank you. And now we'll go to those joining virtually. Please introduce yourself when I call your name. Member Singh.
Good morning, everyone. Peter Singh, MLA Calgary East.
Okay, MLA Allard.
Good morning, Tracy Allard, MLA for Grand Prairie and serving as the Deputy Chair today. Thank you.
Okay, I think that's it. Oh, is Pat Rain on? Pat Rain? Yeah.
Yes, thanks, Mr. Chair. Good morning, Pat Rain, Lesser Slave Lake.
Okay, thank you very much. For the record, I will note the following substitutions. Member Yao for Honorable Minister Jones. Honorable Member Hoffman for Honorable Member Phillips. Honorable Member Allard as Deputy Chair, and Member Diol for Honorable Member Agan. We have a few housekeeping items to address before we turn to the business at hand. Please note that the microphones are operated by Hansard staff. Committee proceedings are live streamed on the internet and broadcast on Alberta Assembly TV. The audio and video streams and transcripts of the meeting can be accessed via the Legislative Assembly website. Members participating remotely are encouraged to turn their cameras on while speaking and mute their microphones when not speaking. Remote participants who wish to be placed on the speakers list are asked to email or send a message in Teams chat to the committee clerk, and members in the room are asked to please signal the chair or the committee clerk. Please set your cell phones and other devices to silent for the duration of the meeting. So we'll go to approval of agenda. Are there any changes or additions to the draft agenda? Okay, if not, someone would like to make a motion to approve the agenda. Member Yao, need a seconder? No. Okay, moved by Member Yao that the agenda for the September 26, 2022 meeting of the Standing Committee of Alberta Heritage Savings Trust Fund be adopted as distributed. All in favor? Aye. Any opposed? Online, all in favor?
Aye.
Aye.
Any opposed? The motion is carried. Approval of the minutes. Next, we have draft minutes for our June 28th meeting. Are there any errors or omissions to note? Okay, if not, would a member like to make a motion to approve the minutes? Honorable Member Hunter. Moved by Honorable Member Hunter that the minutes of the June 28th, 2022 meeting of the Standing Committee and Alberta Heritage Savings Trust Fund be approved as distributed. All in favor? Or I did that already, sorry. Thank you, motion carried. Okay, the Alberta Heritage Savings Trust Fund Act mandates that this committee receives and reviews quarterly reports on the operations and results of the Heritage Fund. We are here today to review the 2022-23 Alberta Heritage Savings Trust Fund first quarter report. The report was publicly released on August 31st, 2022, and a copy was made available to members on the internal committee website. We are pleased to have officials from the Ministry of Treasury Board and Finance and AIMCO joining us to provide an overview of the report and answer any questions members may have. With that, I will turn the floor over to your presentations.
Thank you, Mr. Chair. It's, as always, a pleasure to be here. I'd like to bring you good news, but the first quarter was anything but. Inflation concerns, rising interest rates, the Ukraine, I could probably come up with others, caused significant declines in value across financial markets, which hurt Heritage Fund returns. The actual return for the quarter was negative 4.1%, and the value of the fund fell $825 million, from $18.7 billion to $17.9 billion. In terms of individual returns, during the quarter, inflation sensitive and alternatives had a return positive 4.2%. However, equities lost 9.2% and fixed income lost 4.4%. Now, while this is not good news, it is not unexpected. At some point, when you have risk in your portfolio, returns are going to be below expectations. And the Heritage Fund's mandate is to maximize returns over the long term. And to do that, we have to take risk. If we would have invested only in fixed income or treasury bills, that's the risk-free asset, we would have made about 0% over the last 5 years. A little better, but not much. Of course, as I said, we focus on the long term and not the short term. Over the last 5 years, the Heritage Fund has earned a return of 6.5%. This is 1.1%, pardon me, 0.1% above the long-term target of inflation plus 4.5%. Over the last 10 years, the fund's return was 8.9%, 2.1% above inflation plus 4.5%. In the last 10 or 12 years, the fund has consistently beat the target, the real return target, inflation plus 4.5%. But sooner or later, we're going to have an extended period of time, like the early 70s, where the markets do not return very much. And so hopefully that won't happen, but it could. While returns in the first quarter were negative, they have been worse. They could have been worse, pardon me. The actual return on the fund was negative 4.1%, while the return for the passive benchmark was negative 5.4%. In other words, AIMCO added 1.3% of value. Now, I want to make a point about how active management returns have improved over the last few years. If we go back to first quarter 2021, so 2 years ago, we reported the value added over 5 years was negative 0.4%, substantially below our target of 1%. Over 10 years, the value added was 0.2% after the first quarter of 2021. These figures are much better in the quarterly report being discussed today. Over the last 5 years, the value added through AIMCO's active management was 0.8%, and it was 0.7% over the last 10 years. While these figures remain below our target, The trend is very helpful. Over the last 12 months, the return for the fund was 1.6%, 4.3% better than the passive benchmark of negative 2.7%. So if the trend continues, hopefully we will be above target for active management in 1 or 2 more quarters. Turning now to investment income. The fund's investment income was negative $64 million for the first quarter. This is comprised of negative $34 million in investment returns or investment income and negative $30 million in investment costs. I think I got those backwards. $34 million of expenses, $30 million negative of investment income. One of the reasons why expenses are down this quarter are value-added returns paid to external managers have been much lower. This is an expense item you never want to see go down. Thankfully, it is still early in the year, and there are 3 quarters remaining during which we can make back this negative return. This concludes my remarks, and thank you once again.
Chair, I'll add some remarks and introduce my colleagues. I'm here, delighted to be here on behalf of AIMCO with Amit Prakash, who's our Chief Fiduciary Management Officer, and Sandra Lau, who's Chief Investment Officer. They'll each offer some comments as well. We have redefined AIMCO in the last year and a bit to be an organization that helps our clients secure a better financial future for the Albertans we serve. And we have issued a strategy that has 3 parts. The first is to put our clients first and to focus on their wishes. Secondly, to develop and strengthen an adaptable investment platform that can be tailored to our clients' needs. And finally, to develop a people and culture discipline that results in better results for our clients as well. That is now being translated into an investment strategy, which we will present to our board initially in a couple of weeks, and then consult with our clients after that. That may result in some more changes at AIMCO. To date, we have a new executive team that consists of a blend of folks from the past and new individuals, including a chief technology officer and a chief human resource officer, which we did not have. We've flattened the organization and gone from about 130 people leaders to 80, which improves communication and decision making. And we've gathered them in a senior leadership team that had our first leadership conference last week. The agenda for that leadership conference was around psychological safety, which sounds touchy-feely, but in fact it's quite purposeful. We are a decision-making organization. That's what we do. And we need people to challenge each other effectively and to overcome hierarchy in order to result in better investment decisions for our clients. So a flatter organization and one where people feel safe to speak up will result in better investment returns. We're also pursuing emerging investment opportunities in 2 areas that I should mention to the committee. The first is geographical expansion. We are the most domestic in terms of the portfolio we operate for our clients. And so we are examining opportunities to expand geographically in Asia and other parts of the world. We will do that carefully, but that's in order to have greater opportunities for our clients. And secondly, as I think I may have mentioned in the past, we're looking at transition finance opportunities. There's something like $4 to $5 trillion, depending on who estimates it, required to transition the world economy from a hydrocarbon-intensive economy to a lower carbon intensity economy. And while we believe there will be a future for hydrocarbons in the world, the net zero commitments of some will require a discipline around decarbonization. We think there's money to be made for long-term investors in that area, and we're exploring opportunities there. I'll conclude my comments and ask Sandra to elaborate on markets and investment opportunities more broadly.
Thank you, Evan. Thanks, everyone, and always pleasure to be here to give the report to the committee on the result of the Alberta Heritage Trust Fund. So we are here today to give you an update of the first quarter of the fiscal year of 2022 and 23 fiscal year performance. Like Lo mentioned, the first half of 2022 is really difficult for investor. Indeed, most of the asset class prices declined over the quarter, primarily because of inflation and central bank policy has been the dominated narrative in the last quarter. Inflation continues to be surprisingly on the high side around the world, especially what we witness in Canada and US. We have seen a high print in April and June. As such, central bank, especially in Canada and US, also came in for a very aggressive monetary policy. Both of them increased interest rate by 2% within 3 months' time. Market in general very concerned about the aggressiveness of the central bank, maybe a little bit too late to come to fix the inflation problem, turning maybe a soft landing economics activity into a recession. As such, with this backdrop, interest rate increased significantly, as a lot of you will be aware of. And as a reference point, 5 years Canada rate went from 2.4% to 3.1% over 3 months, giving a negative return of a fixed income market in general from 5% up to minus 15%, depends on the maturity bucket we are looking at. Stock market follow accordingly as well. As such, we have seen a drastic sell-off in the stock market in the last quarter, which is the worst quarterly sold-off we ever seen since the COVID crisis. Stock market sold off in general from a range of 10 to 16% negative, depends on the region. And I guess usually when the equity market sell off, this usually get the headline attention. However, I will comment the last quarter is really the fixed income market. The dramatic sell-off is the real story of the last quarter. The speed of the central bank increase in interest rate, the magnitude of the sold off in the bond market, it's really we haven't been seeing for the last couple decades. Also, the positive correlation between the stock and bonds market, in which stock and bond both sold off significantly during the quarter, it's kind of a unprecedented event. As such, it's really hurting for a typical 60 and 40 stock and bonds portfolio. Private market is not immune to the market backdrop. We are seeing some of the tougher environment for the private market, such as slow M&A, decline in multiple, and also when the private activity borrowing from the public market is getting more challenging. However, on the bright side, I will comment, infrastructure asset continues to be a very strong and high demand asset just because of the nature of it, and the market basically seeking for inflation sensitive asset. This type of asset continues to hold up very well. So like Lo alluded to, with the diversification aspect of the Heritage Trust Fund and also the active management for AIMCO, the Heritage Trust Fund on the first quarter delivering a minus 4.13%, yet outperforming the benchmark by 1.25% because of the active management. This is definitely better than a 60-40 traditional stock and bond portfolio, but a negative return is never ideal for a fund in general. But we hope that with the excess return that AIMCO generate of 1.25% will provide some of the downside protection during a market challenging environment. Long-term return continues to be strong, like Lo alluded to, 6.5% outperforming the benchmark by 79 basis points. 10 years return close to 8.9%, outperformed the benchmark by 70 basis points. This definitely moves us closer, not yet there, for the 100 basis point of the target we want to deliver to the Heritage Trust Fund. I would like to spend a little bit of time to talk about the attribution, how we outperform over the last quarter. Our overall discipline and focus on the illiquid asset class, underweight in stock and bonds portfolio, overweight in cash, definitely attribute to the positive performance. Within the equity portfolio, despite the challenging market backdrop and the equity portfolio return, our focus of being less sensitive to the market in general, focus on the value stock versus the growth stock, actually add to the performance. On the fixed income side, I'll focus on shorter maturity and shorter maturity strategies such as private credit, private mortgages add to the performance. Also on the fixed income side, given we are over in credit, the temporary mark-to-market negative impact due to credit spread widening temporarily impact the portfolio. On the bright side, private asset, including private equity, real estate, infrastructure, private credit continues to do very well, both in absolute return and relative return. Two asset class I would like to highlight, private credit portfolio continues to do very well because of the floating rate in nature, just also because of the lower in loan loss provision and default in that portfolio. One asset class I would like to particularly highlight is infrastructure. Infrastructure returned 9% positive over the quarter. This is all because of the asset class nature I touch on of inflation sensitive. Well, also with the some of the asset we own earn a very good mid-year valuation increase because of the strong quality of asset we own. Now, going forward, nobody have a crystal ball. I guess the only crystal ball we need to look at is inflation. I think going into the shorter and medium term, we are not at all out of the woods yet. Although there are significant pullback in the stock and bonds market, I think it may still be too soon to assess a full rebound in the risk asset until a clear sign of where inflation is heading. Not to mention, away from inflation, there continues to other risks that coming our way, especially of the geopolitical risks. U.S. versus China, the fragmentation of Europe, Russia, Ukraine, those components continues to be impacting the inflation in the forward-looking and also the economics recovery going forward. So as such, how we manage the portfolio for our client and all of our client is continues to remain cautious and being defensive. Make sure we have liquidity in hand that when market present opportunity itself, we are ready to react. So with that, Mr. Chair, that summarizes my my opening remarks.
Thank you very much. Does that conclude? Oh, okay, go ahead. Sorry. Yeah.
I'll just take 2-3 minutes to cover what we are doing with clients. So as we've transitioned quite firmly and intentionally into becoming more client-centric organization, one of the first areas we focused on was to ensure that the lines of communication we have with our clients that is fully functioning. So we've operationalized a CEO council that meets at least once a quarter that Evan chairs with the leadership of all of our clients, and the focus of that forum is on strategic topics, and that's been functioning for about a year and change now. We also have a forum which focuses on more granular topics and including products, risk, leverage, etc., and that's been functioning as well. The second key aspect of building strong connectivity with clients is a whole host of consultations on products, and which allows clients to have good transparency and visibility into products and ensuring that our platform is fit for purpose for their investment needs. And on the back of that, there are changes that are being made on the platform, which the clients would be able to avail of over the next couple of months. And last but not the least, we've also been building quite actively a more focused capability on helping clients with their decision on policy mix, on asset class decisions, on topics such as inflation, and therefore we will be engaging with them about some recommendations in terms of how their portfolio could be better positioned as we look forward from inflation, but other long-term trends as well. So with that, I'll turn it back to you, Mr. Chair. Thank you.
Thank you very much. Interesting times we live in here. So now I'll look to committee members for questions. I'll start on the opposition side, and then I'll go back and forth, and we'll give one question and then a follow-up, and then we'll just keep going that way. So we will start with Honorable Member Gray.
Thank you very much, Mr. Chair, and thank you to everyone from TBF, AIMCO, from the Auditor's Office for being here and your initial remarks. There's lots to talk about in this particular report, but my first question is about some of the government reporting that I'm just hoping to get a little bit of clarity. At our last meeting, where we considered the annual report, TBF and AIMCO reported to this committee that $1.247 billion of investment income was being transferred to the General Revenue Fund. And we accepted that, and this committee then submitted its report to the legislature. But in the government's first quarter fiscal update, they said plans had changed. And to quote from that report, they said the government of Alberta will amend the Heritage Savings Trust Fund Act to provide an option to retain all net investment income in the Heritage Fund for 2021-22. This will allow a total of $1.2 billion to be retained in the fund. So put in another way, the government said in their report that they're going to change the law and retroactively change the financial reporting from the previous fiscal year. And so in trying to understand that and looking at the first quarter report, I think my first question is really, where is the $1.247 billion today? Has that money already moved, or what does that look like, please?
The money never left the fund. The money was and still is invested by the fund.
Okay, so it's currently in the fund, so I appreciate that. So my follow-up would be that we've closed the books for fiscal 21-22, and the committee has submitted its final report for that year to the legislature. And now the Premier and current Finance Minister have stated that they want to pass legislation and retroactively open back up the books for the last year and make changes to the amount to more than $1 billion. And I'm really curious about the mechanics being proposed here, and possibly for the Office of the Auditor General, but what public sector accounting standards come into play with something like this, with the government retroactively going back in time and reversing previous decisions. If you could walk me through that, that would be very helpful.
So the investment income seldom transfers in the same year it is earned. The reason is simple, because until you do the last income statement for the annual or the annual income statement, you don't know how much investment income has been earned. Last year, after 3 quarters, we would have transferred all kinds of money because we were doing very well. And then the 4th quarter, we would have had to take some money back. So I know of no plans to restate the 21-22 books. What will happen is that the investment income, which is already reflected in the 21-22 books, the investment income that is being discussed is the amount that the law currently requires to be transferred to the General Revenue Fund. So under current legislation, to put money into the fund, to retain the earnings, you have to take the earnings out of the fund and then have a supply vote to put them back in. As I understand the proposed legislation, we will be giving an option, or the government will provide an option to either retain the funds or take them out to reduce the red tape it takes to get the money out and in.
We'll go to MLA Yao.
Thank you very much, Chair. First off, Mr. Siddle, to you and your team, thank you very much for all your hard work and diligence in investing Alberta's nest egg with your responsible investments. greatly appreciate that. And some of your comments that you made earlier about flattening the organization, reducing the bureaucracy is music to my ears, and that it gives me confidence that you guys are well self-managed and continue to do things to make things better for Albertans. So thank you all so much for that. I do believe it's important to highlight that what you guys mentioned about the challenges that you witnessed this quarter, and that how they are not unique to this fund, and how these things have affected investment markets all over the world. I'm also aware that the country's largest pension fund, the Canadian Pension Plan, was hurt by a broader sell-off in global equities, and they had numbers of 4.2%, negative 4.2% return in their first fiscal quarter. So, to that effect, can you comment on what are some of the market conditions that have been affecting our investments in the Heritage Fund? How can the rising interest rates and other global concerns affect the value of the assets? Are the actions of our federal government impairing us that much? I swear they're trying to drive us into a recession, but if you could expand on how all these various issues affect your ability to invest in companies. Thank you.
I'll invite Sandra to respond in greater detail, Mr. Chair, but I would say that comparisons between AIMCO and some of the other investment fund managers, pension fund managers, are often awkward because of mixed differences. So, for example, CPPIB would have a much greater exposure to equities than our clients have chosen to have, and as a result would be therefore more affected proportionately by those markets, and that's one of the things that's evident in those results. But Sandra, would you like to add any further comment?
Yeah, sure. Yeah, thanks for the question. And no doubt we are in the extreme challenging environment. And just looking forward, what we experienced the last weeks, the inflation continues to be a topic, and indeed central bank went further for each of them having a 75 basis point further increase on the rate as well. So uncertainty in inflation, uncertainty in central bank policy, and continues will be the biggest challenge of investment portfolio in general. However, like Lo mentioned, and how we manage the Heritage Fund portfolio long term, and diversification is always the silver lining for the portfolio. The Heritage Trust Fund is well diversified in the stock bonds portfolio, and especially on the inflation-sensitive asset. For this well-diversified portfolio, there are different challenges, but also different kind of protection for the portfolio. And allow me to touch on also on the inflation-sensitive portfolio, especially on the infrastructure and real estate portfolio. Those are the portfolio that really provide a very good hedge protection in higher inflation environment. In the infrastructure portfolio is well designed for basic utility, port, airport, and railroad. That allowed us to have a very high transferable pricing power to the consumer or the off-taker. That way it's very heavy inflation protected. Real estate portfolio as well is a very good inflation protection portfolio for the Heritage Trust Fund, especially our exposure in residential industrial that allow us to reset the lease rate on a regular basis. So from that front, it will be a very good protection for the portfolio going forward. The thesis of the portfolio is continues to diversify, and in terms of interest rate sensitivity, it will continue to be some challenge for the stock and bonds portfolio, no doubt. However, the team continues to be disciplined, and also for the risk and challenge coming forward is also means some opportunity. The yield curve is inverted right now. That means the fixed income market is more pricing in the risk of recession coming our way. However, it's also implied when the market settle over time, there are maybe a first opportunity show up in the fixed income market that a patient liquid investor like the Heritage Fund will have the good opportunity to come in to invest on the portfolio.
Another question? Is that right?
Go ahead.
Sure. Would you be able to further elaborate on which asset classes have performed well over the quarter, and which asset classes have performed poorly over the last quarter?
Sure. Like I alluded to earlier, because of a challenging market environment, general asset classes that are more challenging in the performance are basically public investment portfolio, stock and bonds. Illiquid portfolios such as real estate, infrastructure, private equity, private debt and loan, all has been performing very well on absolute return and relative return. The key rationale of those asset class being strong, like I alluded to, because of the inflation-sensitive protection for real estate and infrastructure, and especially on real infrastructure, continues to be a high demand asset because all the investors around the world basically chasing for this kind of inflation-sensitive protection asset. And our portfolio in our private equity portfolio continues to do well because of the strong underwriting due diligence process the team had, and a lot of investment has actually been benefiting from the good tailwind from the recovery of COVID and even of the stabilize of the cash flow and the stable business that we invest in. So as such, even on the private equity portfolio over the last year, we have been benefiting a lot from the performance. Last but not least, our private credit portfolio. The private credit portfolio is actually floating rate in nature. The floating rate exactly is moving as a higher return when inflation going higher. When inflation going higher, central bank hike policy, the floating rate return will go along with it. So the allocation of private credit portfolio also help and has been a strong performance of the portfolio. Unfortunately, like I alluded to, because of the public investment nature, stock and bonds portfolio underperform just because of the market. However, the team has also been doing a good job because of the defensive nature and being cautious on how we invest, and they continue to outperforms the passive style of the index.
So if I can add just 2 more comments in addition to add to what Sandra mentioned. So one of the things that we'll be gauging with clients on over the next couple of weeks as we look forward to a weaker economic environment and inflation that may potentially be higher for longer is a discussion around private credit, private debt, as Sandra alluded to. We're also working quite hard at an absolute return solution, which is quite attractive, particularly in an environment where the market returns, expected market returns, may be lower than they've been over the last 10 years. So those are some of the things that we are focused on, working on with clients that in a forward-looking manner relative to the portfolios that we've been managing in the past. Thank you.
Thank you. Honorable Member Gray.
Thank you very much. I'd like to come back to the current government's stated intent to retroactively change what was happening with $1.24 billion of the Heritage Fund for the last fiscal year. And in your answers, you referred to the annual income statement being finalized, and my question is are we not talking about the final results year-end reporting that was published June 2022, or is that something else? Like I may be confused about that, but specifically, I also am just very curious about this very large amount of money from the Heritage Savings Trust Fund. What happens, because this legislation has not been passed yet, what happens if a new premier comes in and says, no, we aren't going to do that, given the books have been closed? What happens with this process and with these dollars and the impact to the investment decisions that AIMCO is making?
This comes down to a question of when you report income and when you move cash. You report income at the end of as of the end of the fiscal year. That doesn't mean you've transferred the cash. The cash changes as it changes. When you move cash, it goes up and down. When income, you don't have to have that movement of cash to record the income. Income is done on an accrual basis, whereas cash is done on, obviously, a cash basis. So there are often differences between statements and cash. Now, one other thing I would point out is that the legislation, the Heritage Fund Act, allows the Minister of Finance of the day to decide on the timing and method of payment of the, that money that is to be transferred to the general revenue fund. And so, nothing tricky going on here. All that's been done is that the minister has decided not to transfer any funds yet. At some point, the law requires that the funds be transferred to the heritage or to the general revenue fund, but there's no time limit, and so that's the authority that the Minister of Finance is using to keep the money in the fund.
Okay, thank you for that answer. So my question is maybe more appropriately directed to AIMCO. When it comes to the managing of this large portfolio that you have, there's now uncertainty around this 1.247 billion, whether it, my understanding would be whether it needs to be kept liquid so it can be transferred over to GRF, or whether it's going to be invested with the pool of money, and what decisions are happening. On top of that, we now are forecasting an additional 1.738 billion for the next fiscal year. So that's roughly $3 billion. I'm curious from AIMCO what planning work is being undertaken around this $3 billion, and how that might impact future funds total value if it is all kept within the Heritage Savings Trust Fund, but also your investment decisions and the management of this pool of money. How is that impacted by the uncertainty of legislation that hasn't been passed yet?
Just make some general comments. Our different clients have different cash flow needs from time to time, and we work closely with them, including Treasury Board and Finance, to anticipate what those needs are. And we manage liquidity on their behalf in addition to investments on their behalf. And there's an ongoing dialogue between ourselves and TBF, as there are with our other clients. And this is just part of what we do. But Sandra?
Yeah, and well, first off, liquidity management, like Evan alluded to, how we manage for the client is always top of our focus. We always pay attention on the liquidity of the fund in any different shape and form, and we have a very good discipline of proper allocation in public asset class, which is more liquid by design, that provide the clients much needed liquidity, and in this case also for the Heritage Trust Fund as well. Even, I would add, even during a stress environment, we have a very rigorous discipline in place to make sure we have the ample of liquidity to meet the client's need, or even the market environment should we need to deploy. Also, for a lot of withdrawal in the past, sometimes is the billion in size not necessarily happen all at once in one chunk of lump sum. It also happened over a couple months of time. But that said, without the billion or whatever size we need, AIMCO portfolios always focus on the client's need, aka provide the much needed net risk-adjusted total return, and also the liquidity that required for the client. So I think those are the front and center focus of us. And so with the stock and bonds portfolio, liquidity, how we manage rigorously on the liquidity management as a holistic approach, and even different type of facility, we always have standby in case we need much more needed liquidity. We have different process and governance in place to ensure all the client have the ample of liquidity if they need it.
To MLA.
Thank you so much, Chair. During the last fiscal update, it was announced that the government was adding a 2.9 billion one-time investment into the Heritage Fund, and 1.7 billion deposit into the fund from an estimated cash surplus. Can you explain how the extra funds will reflect in the short and long-term returns of the Alberta Heritage Savings Trust Fund, please?
The 2.9 is a combination of the 1.2 in retained earnings and a deposit of 1.7. The deposit, the mechanics of the deposit haven't been worked out yet. We are working closely with AIMCO, but it's difficult to put 1.7 billion all at one time into a fund. It just can't be done, not smoothly. So you're left with some funds in cash or or public markets, I guess, until you can find a spot to reflect the asset allocation.
Yeah, so just to clarify, I recognize it would be difficult to invest it all at one time, not to mention not very prudent to do that. So over what time period do you take the cash and invest that? Do you have a rule of thumb that AIMCO works off of?
We've never been in this, or not been for many years, so we're working on a rule of thumb.
Try to see, make sure you get more money over the next years to, so you can become more practiced at that.
So normally when clients are either putting money in or out, the public markets are easy because they can absorb $1 billion, $2 billion, multi-billion contributions. But the investments into the liquid markets, private equity, real estate infrastructure, that clearly can take longer than public markets. So typically the process we work with clients on is to invest those monies in surrogate liquid markets till such time the real estate or private equity transactions are available, and then over time those monies move into the illiquid markets. In some cases it could be a 1-year period depending on asset class. In other instances it could be 2 or 3 years depending on the size and the investment type.
Thank you very much.
Okay, Honorable Member Gray.
Thank you, and thank you for my colleague, because the line of questioning is something I was absolutely curious about as well. And so I just want to go back to what TBF was explaining around the transfer of $1.247 billion from the last fiscal year, and your language was pretty clear that the Act allows the minister to decide the method and timing, and at this point the minister has chosen not to transfer those funds, and I need to know if there's any legislative time limits on this, or does the minister have carte blanche to it's in the budget. We said we were going to transfer this. The legislature has voted on it. Those transfers don't happen indefinitely, or what is the caveat, the corollary here?
The Heritage Fund Act is silent on timing.
Really?
Yes. I had the same reaction.
Yeah, that's incredibly surprising. Okay, so the Heritage Fund Act is silent on timing, which is allowing the government to delay the transferring of funds that they put in their budget would happen indefinitely until they may or may not pass legislation, because we have political uncertainty, and currently a premier has said they would pass legislation, but there may be a new premier and it may or may not take place. Am I accurately summarizing the state of affairs at this point?
Yes.
Yes. Okay. I appreciate the clarity to understand what's happening. And then in response to Member Yao's question, I heard AIMCO talking about, and TBF talking about, the challenge when you have such a large investment coming in. And so I'm just curious what planning, thinking, strategizing is already happening, knowing that in theory these dollars are being allocated, but we are waiting for the legislation. In the meantime, I'm sure you're busy working on that. If you could walk me through what that looks like.
The process when money's again coming in, going out of any client portfolios centers around a couple of things. So firstly, in this instance, the money's coming in if he was simply doing a pro rata across the current portfolio. So that's ground zero, if you will. The second bit is, to that view, some of the things I mentioned earlier about private credit, about absolute return, etc., some of the newer things we should be looking at. That's the second part that we would engage with clients on in terms of what the incremental dollars may look like. And then the third part is more the implementation around the timing, which asset classes, which pools, which provide greater certainty around the timing. So for example, if monies were coming in the second week of December, you may not want to trade around Christmas because market liquidity is really down. So that really goes down into the bowels of the implementation decisions around client contributions. Sandra, anything to add?
Yeah, no, I think Amit summarized it very well. And given the asset mix of Alberta Heritage Trust Fund is a well diversified portfolio of stocks, bonds, and illiquid, and at the same time, ideally, is to pro rata allocated it. However, in some of the market challenging function, you don't want just place the money to illiquid asset for the sake of just like deploying the asset. We still would like to find the prudent best asset for our client. As such, it may take some time. So as such, we will just more temporarily put the money into the more liquid asset class as we go. But and that's usually typical of the process.
Okay, we'll go to Honorable Member Allard now.
Thank you very much, Mr. Chair. Good morning, everyone. Thank you for your presentations. It's unfortunate that we're in this position, but I appreciate your candor with respect to how we will address it. I'm just going to reference on page 1 of the quarterly report. I see that the quarter's losses are expected to be recovered in the remaining 3 quarters of the year. And I just wanted to ask a couple of questions around that. First and foremost, from reading the report, it's my understanding that the bulk of the losses are actually not realized yet. Is that correct?
That is correct.
Excellent. So I just wanted to ask then, with respect to the losses as of the date of this report, when we look at investments, and I don't have to tell you guys this, it's a little bit, it can be a little bit misleading for the public to look at a loss on any given day, particularly over a short time frame. It can make them feel that, you know, the sky is falling when really this fund is managed on a long-term basis, as many of my colleagues have alluded to this morning. And so I just wanted to know what is the forecast? What's the thought around the bulk of these losses not actually being realized? How realistic is it, given the geopolitical realities and the other challenges with inflation that you've already mentioned, that the bulk of these losses will recover over the next 3 quarters? What's your prognosis on that?
First of all, I don't recall, and I can't find where it says that we expect that income to be made. If we did say that, my apologies, because I have no idea, and we have no idea what the markets are going to do over the next 9 months. If we had an idea, we wouldn't be sitting here. Was there more to the question?
Well, I guess I'm just wondering, for the benefit of the public who may panic seeing this release of information, you know, overall, this is a broad fund, it's diversified. I realize this is not the best time or market to be investing in. It's a challenging market. But when I look back even a year ago, the reverse was happening. We had unexpected, larger than normal gains. And so as you balance it out over a number of years, as you've said, the last 5 years we were at, I think, 6.5%. I guess maybe my question is, in the bigger picture, what would you anticipate? I realize you don't have a crystal ball, but what would you anticipate for the next 5 years to look like in terms of, do you think it's realistic for the fund to continue to perform at or above target?
That's a great question. When we do our budget planning, we take a model and we estimate returns for the long term for all the asset classes. We estimate the risks, and basically we run a simulation, or about 10,000 simulations, of what, if all those variables interact randomly, what the returns will be. That's how we come up with the investment income forecast. Our current modeling is that some of those losses that haven't been realized yet are going to be realized, which puts a negative impact on the existing portfolio or the existing year's income. So I'm not sure if that covers it.
If I may just add, Microphone behind. Thank you. Mr. Chair, this is as Mr. Epp said, we manage the portfolio over a long time frame, 10 or 20 years. But if we were to report every 10 or 20 years, it sure wouldn't be the version of transparency that members would expect of us. So we report more frequently, and it's inconsistent, the timing of our reporting, with the timing of our investment horizon. In making those reports and in doing them most accurately, we reflect the market environment at the time and make estimates about what that says about current valuations for the assets in the portfolio. They do fluctuate a lot, and a long-term investor can tolerate those fluctuations. And we certainly hope to regain these losses, but like Mr. Epp, I would not predict or promise that. I don't have that crystal ball.
Mr. Chair, one follow-up, if I may.
Okay.
Thank you for that. Yes, I am ever the optimist, so my cup is half full when it comes to this. I hope that there will be significant recovery over the next 3 quarters. I guess one of the questions I had was with respect to the strategy and the requirement to be nimble and shift your strategy as you look at the challenging market before you. One of the things I think about is the target asset composition. How is it determined and how often do you shift that? I realize it's not necessarily the easiest thing to shift it on a moment's notice, but is there some work being done to look at how often that needs to be reviewed given the shifting market that we're in?
So ideally, we would do an asset allocation study every 3 to 5 years. That matches what pension funds do. However, to be honest, we haven't done that. We've done minor changes to the mix in the last 10 or 11 years, but we have not done a comprehensive review. We are in the middle of a comprehensive review, and quite frankly, when we started, the world looked a lot different than now. So we've gone back and we are currently reevaluating and resetting our expectations of the future. So that's basically how we do it.
Thank you very much. We'll go to Honorable Member Hoffman.
Thank you very much, Mr. Chair. I have a couple of questions as it relates to international investment. And the first one, in the introduction, there were comments made about the impacts of the uncertainty as it relates to conflict, Russia invading Ukraine. And my question, both to AIMCO and to the department, would be around what have we done to ensure that no Alberta investment dollars are funding this invasion, that we're not investing any Alberta money that belongs to the people of Alberta in supporting the illegal invasion and war that Ukraine is experiencing as inflicted by Vladimir Putin.
We announced in the immediate wake of the invasion on behalf of our clients that we had made a decision, an investment decision, to exit as quickly as we could all exposure to the Russian economy. I think, Sandra, that's complete now?
Yeah. That's completed, and if basically the Russian the market is closed, and we have all those effort to divest from the asset. That said, going into the Russia and Ukraine situation, our exposure from AIMCO to Russia or Ukraine is like relatively insignificant, and I would describe as minimal. We have no direct investment in the illiquid asset in Ukraine and Russia. We only have probably close to less than 1% or even less because of a passive public equity investment in the asset. We also immediately look at the second derivative impact of any other institution or other holding that we may have indirect exposure to Ukraine and Russia, which is no indirect exposure as well. And all the action has always also been taken to assess the liquidity situation and the market situation at the time that happened. And with Evan's call, and we immediately divest the investment as one of the first Maple investor coming out to announce the divestment of Russian-Ukraine exposure.
Thanks for that response. So I I heard no direct investment and that market's closed. I guess I'm wanting to ensure that we're doing everything we can to ensure that no Alberta money that belongs to Albertans is being invested in funding this illegal invasion. And I think I'm seeing a nod on that. Thank you so much. So my second question is, it's not the only place right now where I'd say there's geopolitical risk. Certainly in the South China Sea, there's a lot of tensions at this time. So I'm hoping that you can walk us through what's being done to ensure that our geopolitical risk is minimal and that we are certainly not aligning ourselves with things that I think the majority of Albertans would feel are ethical concerns when it comes to investing their money. So what's the team look like? What's the policy like? And how are we ensuring that we're acting as ethically as responsible when it comes to investing Albertans' money?
Sure. I will address it in a couple angles. First of all, as a diversified portfolio, Inco portfolio or a heritage portfolio is always invest in a diversified geographic region. And we are very mindful also on the country we're going in. So our exposure is basically the typical developed market and some of the emerging market. And when we don't have exposure and a lot of deep frontier market, and sometimes a lot of it will be a risk of the country risk and regulatory risk and different kind of jurisdiction risk that we consider as well. Now, as far as policy, because of the diversification of aspect of it, the portfolio is closely monitored and make sure we have control and limit on each country. And we also have control and limit on some of the country we will not invest it in. And also, if going into any country or any other region, there is a thorough process, not only the investment team doing the underlying due diligence and also the risk team, and involve the responsible investment team sometimes to looking at the country on the country risk in particular that we are assessing. So from a different angle, from the control of the diversification we have on the underlying due diligence for any country we have and the limits and the discipline of we not going into some country in particular. So there is the assurance that we did not invest in any country that we think is unethical or there was a social issue alongside with it.
Would MLA Singh?
Thank you, Mr. Chair. And thank you, the representative of the Treasury Board and Finance and officers of AMCO for presenting the first quarter report before the committee today. And my question is, can you please explain the equity component of the fund and how are these investments impacting the performance of the fund and how have they performed over the last 5 and 10 years?
So the equity component of the fund is the accumulated operating surplus. In the statements, that's what it's called. It's all the money that has been retained and not paid into the general revenue fund or other projects early on. So if you look at the financial statements on page 4, you'll see an accumulated operating surplus of just over $17 billion. And that's assets less liabilities, very simply. I forgot the second part of your question.
Second part is, and how have they performed over the last 5 and 10 years?
They are intermingled. There is no separate pool of retained earnings set aside and invested differently. All of that money is commingled and it earns the same returns as the rest of the Heritage Fund.
Thank you for answering. And I see that the Heritage Fund benefited from gains in inflation-sensitive investments such as infrastructure and real estate. And can you please state how much did this group of investment earn in the last quarter? And what factors made it possible if these investments to grow compared to other asset groups?
Sure. I will address that. So the Heritage Trust Fund actually have a good exposure to inflation-sensitive asset, like you are alluded to, and those asset is first of all generating a very positive cash flow. Sometimes the cash flow of it is adjusted to inflation, such as the off-ticket contract and the constant contract we have on the infrastructure asset. And on the real estate side, it's especially like I alluded to on the industrial and residential, and sometimes the lease can adjust because of the inflation. So those component of it, and I would argue within the two pool, is a perfect inflation-sensitive protection asset. And the beauty of that asset is also in the infrastructure asset class, there are a good tailwind coming along our way. For the asset class continues to be looking at alternative sub-asset class, such as telecommunication and also in green energy. Those are the two themes that create a lot of tailwind, that create a very strong return, including the inflation protection. One of the good example is such as one of the investment that we have through the S-Power. They have invest a lot in the solar energy, which is giving us a very good valuation lift. And on the real estate side, it's the residential and the industrial part that provide a very good inflation protection. Now, how do we grow on those two assets? And I think the team continues to be working hard to grow those illiquid asset classes on behalf of the client, in which we find, in addition to absolute return or private credit, those are the asset class that is a very good strategy to grow for an inflation environment going forward. The team is working hard, but also we are mindful of the backdrop. And I think we love to grow the asset. However, we want to grow the asset in a much disciplined approach, identify the asset that represent value, and with the good risk-adjusted return we are looking for, to ensure that will provide the much needed diversification for our client, but also mindful of the entry point of how we identify the asset and the valuation of what we are coming in for the asset.
If I can
Thank
just
you.
add,
Go ahead, sir.
add a quick, add some color on performance. So last quarter, real estate was up 1.9%. The 5-year return is 5.1% annualized, and infrastructure 9.6% for the quarter and 8.1% annualized for the 5 years. And lastly, as context, across these two asset classes, it's about 30% of the overall portfolio.
Okay, thank you very much. We will now go to Honorable Member Gray.
Thank you very much. Appreciate that. Just as a follow-up to the line of question we were just talking about, and I'm curious, the real estate side, industrial, residential, are inflation protected, and we're seeing good returns in that class. Is that because people's rent is going up? Like, is that I'm just trying to better understand that, but is part of it because those assets are passing on those inflation costs to, do you understand what I mean? Like,
two component of the real estate is the income generation in general. Usually real estate will have a good income generation, which is around 2-3% of in general. And the other part of it is also value creation of it. So the two component that we would on a real estate return is that. And the inflation protection side also come from is the rent component and the lease rate component that is more frequently adjustable in case it's need to adjust up or to adjust for the economy environment.
I should just elaborate, if I may, that this real estate portfolio includes commercial, industrial, and residential real estate. And I'm actually not sure what the concentration of residential real estate is, if you know it offhand.
I think it's about 25%, 20% in both industrial, 20% in the residential, and like Evan alluded to, is including also office, retail, and it's also diversified across different geographic region of Canada and U.S. and UK as well.
And where some of that resiliency comes from is investments in areas such as data centers, logistics, industrials. So as all of us know, with the proliferation of the Amazon fulfillment centers and the like, so there are big chunks of the commercial real estate which continue to do well.
Thank you. That helps very much. I appreciate the higher level of detail there. For my follow-up, I would like to just ask a little bit more about what's going on with inflation and the impacts that we are seeing. And I know Ms. Lau referenced this in her initial comments, because we're certainly seeing last week, the U.S. Federal Reserve Chairman announced rates were increasing by 75 basis points, but then, which was expected, but then with the surprise said rates could rise another 150 basis points. 2 months ago, the Fed forecast 2 rate increases of 75 and 50 basis points. That's a swing in the forecast of 100 points in the forward guidance in just 60 days. And I appreciated the opening comments that touched on some of this and suggested we're not quite out of the woods. I was hoping to dive into this just a bit deeper, if you can interpret what this means, if AIMCO is expecting a hard landing, and what these rate increases ultimately mean for both Alberta's economy and the Heritage Fund.
I'll invite you to elaborate in a sec. Having spent a little time at the Bank of Canada, I will just offer that the Monetary Authority's objective is price stability. Runaway inflation is something that we saw in the early 70s that is very socially harmful. And my sense, although I have no inside information, is that monetary authorities would risk a minor recession in order to ensure price stability. And I think that's what their agreement with the federal government is to do, in particular our Bank of Canada. As to predicting where that ends up, the bank rate is actually a very blunt instrument, and they're trying to control price stability with one trigger. As a result, it does result in some fine-tuning over time. Now, where that goes, Sandra, I'll let you predict, because I can't do it.
All right, I'm not going to predict, but I echo Evan's comment. Like Evan alluded to, monetary policy is really a blunt instrument, and it's always lagging. So unfortunately, we have seen inflation continues to be stubbornly high. Although energy in general, the prices has come down a little bit, but we are also facing a very tight labor market. As there is still concern that if there will continue to be other inflation component coming from wages, goods and services, in which it's really make up of 50% of the inflation component. And if those of the inflation component is not under control, it can easily turn us into a structural inflation, more a high inflation going long term. As such, that's why the central bank has been coming in very aggressively, try to control inflation. As for the next quarter that we have left, like Evan mentioned, central bank basically very upfront. Price stability will be the front center focus of them. We won't be surprised to see a more aggressive central bank action for the next 2 meeting, which is coming up in the next quarter before year end, which easily bring the front end rate from 3.25%, and maybe we are touching 4%. Now, the challenge is when the interest rate going into a very high situation, like if we are approaching 4%, then the probability of a recession will be getting very high, just because of how it impacts the economy and how it impacts consumer spending. So 4% will be really a stretch number if inflation getting there. But at the same time, I think with that, we are seeing the sign of a certain component of inflation already coming down. So with the monetary policy being in front of it, I think the market is generally maybe pricing in if there is a recession coming our way. Hopefully it will be a relatively shallow inflation, short-lived, and for a period of time. And inflation and interest rate policy would be data dependent. So with a more front end of the adjustment coming to it right now, with the adjustment and the monetary policy kick in, the expectation generally will be 2023 later on. We will see a flat out or a stabilize of a hiking of inflation and or interest rate and inflation in general. Maybe the impact and effect will die down eventually. So I don't have a crystal ball, and that's why I was more alluding to for the next 3-6 months. I expect the market continues to be bumpy, and for the recession, it's really a wild card. But however, the direction of the market is really more and more pointing to a recession scenario. After all, the yield curve is inverted. Every time a bond market yield curve is inverted, is a good sign and is a strong sign that we are seeing recession coming our way. Thank you.
Okay, well, our sequence will be Honorable Member Hunter and then Honorable Member Hoffman, and if there's time, we'll go to ML or Rain. We'll try to wrap it up, this part of it, until by about 25 after. So, Honorable Member Hunter.
Thank you, Mr. Chair. I just wanted to do an observation first, and then my question. My observation is that earlier, honorable colleague, committee member, Honorable Christina Gray, was questioning really, why Treasury Board would be moving, basically $2.9 billion over. It kind of sounded like a negative. She felt it was a negative thing. I personally, as a committee member, can tell you that I consider it a very positive thing that we're actually giving back to Albertans and future Albertans $2.9 billion. It's something that I applaud the government for doing, and that we were in a position to be able to do that. I don't know the last time that we've been able to provide that kind of support to the Alberta Heritage Trust Fund in my lifetime. Maybe the last time was in Ralph Klein's time. So I'm grateful for that move, and I hope that you guys find good places to put that money for future Albertans. My question, Mr. Chair, through you to the honourable members, is about the equities. Equities, as you show in your first quarter, were negative performing. Now, we talked about this, and it was no question in anybody's mind that we were going to see some negative numbers here. I can remember sitting in committee meetings where we talked about this, and so I just want to point out that in 2021, in the 2021 draft committee annual report, it showed that equities were sitting at 50.3%. Today it shows that they're sitting at 47.2%. We've basically moved less than 3%, well actually 3%, a little less than 3%, out into more of a inflation sensitive vehicle. My question to you is that all we could move out away from that risky vehicle to a non-risky vehicle, or is it just because of the magnitude of what you guys deal with? How come we couldn't have protected more of that money?
Well, we didn't have the benefit of hindsight at the time, of course, and so had we known these sell-offs would have occurred, we would have moved more. Most of that adjustment, Mr. Chair, is just the result of public markets underperforming private markets, and therefore that amount declining by more. Happily, the Heritage Fund has about a 10% allocation to private equity, which is significantly more than most of our clients, and that particular group actually made money. It made 2.5% in the quarter, versus Canadian public equity markets having lost 11.6%, and foreign equity markets are in our portfolio having lost 11.9%.
I get that nobody has a crystal ball. I wasn't trying to say that you guys did something wrong there. I'm just saying that I remember being in committee meetings in the past and talking quite openly with members of AIMCO and Treasury Board and Finance, and recognizing that when you put that much money into an economy, you're going to see inflation. You didn't need to have a crystal ball for that. So again, is there an ability to move more out than say 3%, or is that kind of the maximum horizon that you guys can actually move out?
Sandra, elaborate on how that.
There is the ability to do that, but it's more on a certain capacity or the guideline we got from the Treasury Board and Finance colleague. But I would say that having or not having a crystal ball is one thing. You can argue you can equally move a major chunk of equity at the same time to the other asset class. But however, there is a probability that's being wrong at the same time that this $2 billion can easily turn bad on this mix. As such, AIMCO approach and even working along with the client is always diversification. And I will add that too, if you look at a 10 years performance result and even longer data result, the portfolio of heritage funds went through different cycles. It went through long-term capital, dot-com, Asian crisis, credit crisis. Every episode of the equity market sold off is a consistent, strong, positive return. And that is the essence of running a long-term portfolio. We should maybe have, it's true that you can adjust 20 billion of equity in and out. But what is a more prudent approach on the risk appetite of the client, the prudent approach of managing a long-term portfolio? And I think the discipline of diversification over a long run is still our core focus when we're managing the money for our client.
I just want to begin by clarifying that what I heard through the exchange by my colleague, the Honourable Christina Gray, was that the committee gave direction. The government has said that the government will change the law, but has not changed the law. So the government is giving direction that is incongruent with the direction of the committee and with the current law. So I just want to be clear about that. The outcome, I think, is fair for us to discuss, but I think the question was about accountability and transparency and actually following the law. In terms of my two questions, they both have to do, one stems from the last exchange, and I appreciate the response around there being a number of countries that we no longer invest in because we have concerns about some of the ethical implications of investing in those markets. And I think it would be, again, around a line of transparency, appropriate for us to have that list of countries presented to the committee in writing, and I'm hoping that we can have concurrence on that, please, through you, Mr. Chair. In writing, thank you very much. And then the second one was based on a prior meeting that I wasn't a member of, but I've had an opportunity to review. Treasury Board and Finance Committee told this committee that the investment strategy was under review, and I imagine maybe some of that has to do with some of these questions around long-term returns and risk management and geopolitical situations as well. So I'm hoping that we can get something, again, in writing in response to this committee about where we're at with reviewing the investment strategy and giving direction on that. Is that possible, Mr. Up?
And the answer is we are in the process of reviewing the investment policy and how much we put in various asset classes, equities, real estate, fixed income, and subclasses, fixed income, public markets versus private debt. We are looking at that. We were close to getting a decision, and changes in the market necessitated a relook.
So through you, Mr. Chair, would it be possible to get some sort of timeline or some sort of clarity on what that will look like and when we can have, as stewards of the fund, some clarity on what that mix will look like and when we can expect to have that formula set, Mr. Chair?
So I guess we're good on that, or? Yeah, okay. All right, great. Okay, I think we'll have call her done for the questions. So we'll, if there's, the committee should now consider a motion. Sorry? Yeah, I'll get to that, yeah. The committee should now consider a motion to receive the first quarterly report. Who would make that motion? Okay, MLA Yao. All in favor in the room or online? What? Oh, I'm sorry. MLA Yao moved that the Standing Committee of the Alberta Heritage Savings Trust Fund receive the 2022-2023 first quarterly report on the Alberta Heritage Savings Trust Fund. So, all in favor, online and in what? Oh, sorry, any discussion? Sorry. If not, then we'll go to the vote, sorry. All in favor, please say aye.
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 Any opposed, say nay. Okay, that motion is carried. That will conclude today's business with respect to the fund's first quarterly report. I'd like to thank our guests from AIMCO and the Treasury Board and Finance and the Office of the Auditor General. You are welcome to leave, but if you want to remain and hear the rest of our business, feel free to do so. So thank you very much.
Thank you.
Okay, and other business, I will note for the record that both Treasury Board and Finance and AIMCO have provided the committee with written follow-up responses to questions asked at our last two meetings on May 30th and June 28th. They were made available to the committee members on an internal site prior to today's meeting. Are there any other issues for discussion before we wrap up today's meeting? Okay. The committee's next meeting will be the annual public meeting on Thursday, October 27th, 2022, from 7 to 9 p.m. There's nothing else for the committee's consideration. I'll call for a motion to adjourn.
Right here.
Okay, moved by MLA Yao that the meeting to be adjourned. All in favor, say aye. Aye. Any opposed, say nay.
Aye.
Thank you. The meeting is now adjourned.